And the fun continues, my friends. We're now going to look at other overhead costs. So overhead is made up of indirect materials, indirect labor, and other. So the other overhead would be things like factory rent, factory depreciation, and any other factory-related cost that isn't an indirect material or indirect labor cost. So in this example, we have utilities for the factory of 21, rent for 16, and miscellaneous overhead of 3. So we need to shove all of that into our overhead T account. In order to do that, we're going to debit the overhead T account to increase our asset. And then we could put it all in account payable. It could be cash, whatever the case is. In this example, we're assuming all of these are paid on account, but we could be crediting cash. We could be crediting accumulated depreciation if it's a depreciation cost that we're including here. So you might have to review your financial admin 502 notes if you don't remember any of this stuff. And we'll be reviewing it in class as well as we go through various examples. But the bottom line, what you need to understand is these costs would have been expenses back in 502, but because they're production costs, they become part of overhead. And then they're going to end up getting allocated to WIP and then to finished goods. And then finally, they'll be expensed when they are sold. So it's important to remember all of our product costs become assets first. Now what happens? Well, we've got our direct materials and direct labor into WIP. Now we need to apply our overhead into WIP. We're going to do that using our predetermined overhead rate. So assume Ruger uses a predetermined overhead rate of 6 per machine hour. We determined how to calculate that back in Chapter 2. And then it says also assume that during April, 10,000 machine hours were worked for job A, 5,000 for job B. Thus, 90,000 in overhead cost is going to get applied, and they got that by using the applied formula for overhead, which is the POHR of 6 times the actual activity, which is a total of 15,000 hours. So 90,000 in total is going to be applied, which means we take it out of the overhead account and put it into work in process. Because those are both assets, the out is going to be a credit and the in is going to be a debit. So the out happens when we credit overhead, and where are we putting it? We're shoving it in to work in process. So we're taking it out of the overhead bucket and moving it in to the work in process bucket. Again, think logically, outs and ins, ups and downs, and then you can always look at your conversion guide to determine the appropriate debit or credit. In addition to the product costs, we'll also have non-manufacturing costs, which would be our selling and administrative costs. Some examples are provided on this slide. You can read through them if you'd like. So let's look at what our company Ruger has in store for us. So Ruger Corporation incurred $30,000 in selling and administrative salary costs during April. So now we're doing straight up journal entries from 502. So if we had selling and administrative costs, we would have a selling and administrative salary expense and the related payable for number 6. So salary expenses goes up with debits, and then if we haven't paid it, our liability, we owe it, would go up with a credit. Then depreciation of $7,000 on our office equipment would mean we have a depreciation expense going up, and then accumulated depreciation is going up. But remember, accumulated depreciation is a contra asset, so that's actually making assets go down. And that's consistent with credits making assets go down. So we debit the expense to make it go up, and we credit the accumulated account to make the accumulated go up and assets go down. Remember, accumulated is a contra asset. It's a negative asset. Again, look back in 502 if you need a review. Advertising was $42,000 and other selling and admin were $8,000. So we'll pop those expenses on. Advertising expense goes up with the debit. Other selling and admin expense goes up with a debit. And then our liability goes up if we paid for those on account, or cash would go down. Either way, you'd end up crediting account payable or cash. Depends how the question is phrased. So now that we have all of our costs recorded, it's now time to figure out how we go from work in process to finished goods. So when we complete the product, the cost of the completed goods is referred to in managerial accounting as cost of goods manufactured. So the amount is going to come out of WIP and go into finished goods. Because these are assets, they go up with debits and down with credits. So we're going to suck it out of WIP with a credit and put it into finished goods with a debit. So job A was completed during April and job B was incomplete. Thus, the following entry transfers the cost of job A from WIP to finished goods. So we would need to look at our job cost sheet to figure out the total cost associated with job A. It would have to be given to us in the problem. Here it's just assumed that it's $158,000, but for you to do the actual journal entry, you would need to know that amount and be given that amount. So the direct materials, direct labor, and overhead costs associated with job A are $158,000. So we debit finished goods for that amount to add it to finished goods, and we credit WIP to take it away. Because job B was not completed by the end of the month, its assigned costs remain in work in process. If the balance sheet were prepared at the end of April, the cost accumulated so far for job B, 72, would appear in the WIP account. So we need to know the direct materials, direct labor, and overhead related to job B. That would be the amount that would remain in work in process. Remember, all jobs are made up of those three fundamental costs: direct materials, direct labor, and manufacturing overhead applied. What's the next step? Well, now that I've got it in finished goods, I can sell it. So when we sell it, it comes out of finished goods and goes into cost of goods sold. Again, WIP and finished goods are assets. They go up with debits, down with credits. Cost of goods sold is an expense. It also goes up with debits and down with credits. So when we take it out of finished goods, we credit it, and then we move it into an expense. And to do that, we debit the expense. So it says we'll assume 750 of the 1,000 gold medallions of job A were shipped to customers with sales revenue of $225. 1,000 units were produced at a total cost of $158,000. So each one cost $158. So how are we going to do this? Well, you got to really hone back to your 502 skills and remember that when we sell goods, there are two journal entries that are needed. The first to record the sale and the second to record the cost of that sale. So the sale part would be for the $225,000 that we sold the medallions for. We increase receivables if it's sold on account. And you do that by debiting the receivable because assets go up with debits. And then you credit the revenue because our revenues go up. Remember, as we sell products, revenues increase. Revenues are simply a record of what's been sold over time. 502 flashback. And then we have our cost of goods sold. Well, it's $158 a unit, and we sold 750, so that's where the $118,750 is coming from. And we would increase cost of goods sold with a debit because expenses go up with debits, and we take that same amount out of our asset account, finished goods, with a credit because assets go down with credits.